Hi and welcome to Livewire Markets. I'm Mia Kwok, and today we have a very special guest that we're speaking to, one of Australia's most prolific economists and head of investment strategy at AMP. Welcome, Shane Oliver. Thank you for joining us.
Thank you, Mia. Great to be here.
You come from a very vast investment universe, Shane. So I wanted to just kick this off with asking you what your favourite investment class is.
To be honest with you, I'd have to say shares. And bear in mind, I don't work for a stockbroker, never have, so I'm not a stock spruiker, so to speak. But I like the liquidity that shares offer. It's very easy to get in and out. I like the fact that you can get massive diversification in the share market across all sorts of exposures to the economy and industries. I like the fact that it delivers for you over long periods of time. It may not in the midst of a crisis, you go back a year ago, in the midst of the pandemic. But over long periods of time, it does what it says it will do. It will provide good returns consistent with the performance of the economy. And I think that's just the price you have to pay for the volatility. And I think it's an incredibly interesting asset class because of all that diversification that's in there, all those different stories that are going on with regards to the companies that the share market will give you exposure to. Now, that's not to say that I don't like property. I do like property. I live in property. It's necessary, and I do have some in cash, not a lot, particularly where interest rates are. And I think there is a role for bonds in a portfolio as a diversifier. But in terms of ticking all the boxes for me, I'd have to say shares.
You've been through a lot of cycles over the years, a lot of so-called crises. How do you read where we're at in the current market cycles?
Well, I think the key is to have a sense of perspective. I mean, there's a couple of things I would say here. Over the years, I've learnt that you have to turn down the noise to some degree. Now, there's a lot of useful information out there, and I recommend to people to work out what is the best source for them and stick to that. Because if you're just taking it from all sources, you're going to get very confused. And all the evidence in terms of behavioural finance suggests that when people are shown a lot of conflicting information from lots of different sources, they can get more and more cautious and end up undertaking or in investment strategies that aren't right for them. Which I think is a bad thing. So the first thing to do is to try and get a clear head, try and turn down the noise. The second thing to do is put things in perspective. We do go through these ups and downs, and they both can be just as concerning, although it always feels bad on the down. But just put things in perspective. I think that's very important. And thirdly, to have some sort of process. It could just be a mental process that you go through, that you look at these things in relation to a particular investment, whether it be a stock or an asset class. You would probably want to look at its valuation, whether it's expensive or cheap, what sort of return potential it's offering longer term, where it is in its cycle, and that might be a guide to its earnings, for example. Obviously the liquidity backdrop around it, in a macro level that's interest rates and so on. At a stock level, it's a guide to the sort of flow of money coming into and out of that stock, and also sentiment. If everyone is telling you the same thing about an investment, that is fantastic or that it's terrible, then you should question that crowd, because history tells us that not necessarily straight away, but over time, the crowd is invariably wrong. And you should be cautious of that. So I think the key is to have some sort of process. Now, you might want to throw in some technicals as well, and I do a little bit of that when looking at stocks and markets. I do find that quite useful, but maybe it's not for everyone. But I think the key is to turn down the noise, put things in perspective, and also have some sort of process.
I think that we're currently at a time where there's more noise than ever. I mean, you think about the social media chatter that goes on. We've got WallStreetBet style investors causing surges in the market. So how do you respond to that noise, or to tuning it out rather?
Well, key is to turn it down and to also realise there's no free lunch, and that a lot of this stuff has been seen before. So I recall back in the late 1990s, people saying that if you don't get tech, you just don't get it. You're an old fuddy-duddy sort of thing. And then of course, tech, a lot of people got tech. It just got a bit ahead of itself in terms of the valuation. So what's going on with Reddit and those sorts of things now, I think are akin to the day traders of the dot-com era. Again, just as the dot-com people were sceptical of the old baby boomers the day traders are sceptical of the Gen X's from the dot-com era sort of thing. So it's always like that. The new generation comes along and thinks the old people don't have a clue, and they have to relearn the old lessons again. Now, if you're an old soul, you've been reincarnated a few times. You can debate whether that happens or not, but let's assume you are. If you're an old soul, you don't need to go through that. You realise that there's no free lunch. But if you're not, it is just worth looking at the history of share markets and the way they behave. Just bear in mind that when you do go into these chat rooms there, that some of the people there are encouraging you to go buy this or that stock, Gamestop or whatever it is, may have other motivations. And you've got to wonder sometimes as to whether they're trying to get you to do something so they can profit from a position they already have. And there is some evidence that a little bit of that's going on, not necessarily with Gamestop. But I think these sorts of things should keep people a little bit cautious. I think the key is to find good sources of information that are curated, that are put together in a consistent way from people who have some understanding in markets. And I probably wouldn't include stuff in chat rooms on that.
You mentioned there are some similarities to the day traders and the dot-com era. Do you think that we're at a similar point now where things are overvalued, there's a little bit too much hype in the market? Where would you position that?
I worry about it a little bit. I know that if I look at price earnings multiples and lots of other valuation measures, they are quite high. I'm also conscious that if you attempt to properly value share markets, you have to allow for the level of interest rates. And when you do that, share markets still offer you a pretty good premium over the return you can get from government bonds. You just think about it this way. The bond yield in Australia is 1.8%. The earnings yield, this is the inverse of the forward PE, is around about 6.8% thereabout. So you've got around about a 4% risk premium in there. Is that right? It's about 5.8. It's about 5.8. So it's about a 4% risk premium in there, which historically has been reasonably good. You know, the excess return on offer from shares compared to the return on offer from bonds is reasonably attractive. So that tells me that as long as interest rates stay reasonably low, we're going to see a bit of a rise this year, then share markets will do okay. They'll do better than bonds. But you just have to allow that the easy gains in this bull market, which started in March last year, March the 23rd, that was the low point in Australian and US shares, and I think also global shares. Those easy gains are behind us. History tells us that the first 12 months out of a bear market low, and that's what it was a year ago, see very strong gains. On average in the US it's about 60-odd%, in Australia it's a little bit less than that, 50-odd%. But the second 12 months sees somewhat lower returns. They are normally positive, but they're somewhat lower and you get more volatility through there. And the reason is because you go from a very cheap market, everyone's bought up the cheap stocks, pushed them back to fair value, slightly expensive perhaps, then you're reliant on the earnings coming through. We are seeing that, but it's a harder slog. And so that's why you get these slower returns. Ultimately, even though there are some signs of excess out there, and maybe you can argue that is shown up in the enthusiasm on some of the chat sites and so on, ultimately those share markets don't bottom out until a bunch of other things happen. You get more excess in the economy, a real surge in inflation, central banks slamming on the brakes, massive growth in debt and so on. At the moment we're probably not at that point. So yes, we could go through corrections, but I don't think we're at the point of extreme excess, which would be consistent with a major market top in markets.
And you mentioned there that you think interest rates are going to go up this year. Is that in Australia or globally?
I think they will go up. Well, I was thinking bond yields will probably go up a little bit more this year, so they'll probably continue to drift high. I don't see a massive rise. It's been interesting to see some bad inflation numbers coming out in the US. By bad, I mean higher than expected inflation numbers. Bad inflation used to be a year ago, it was on the low side when it was too low. But we are seeing higher inflation come through. That is consistent, I think, with a rising trend in bond yields. And they may push up towards 2% by year end. But I think in the absence of central banks seeing that as a major problem. See, central banks have this bit of a dilemma at the moment because they went through the whole of last decade thinking, fantastic, we're back to normal. Turns out we weren't back to normal. The issue was still one of very low inflation and worries about deflation. And so they learnt from that they don't want to move too early. And so if central banks remain of that view, then we're probably going to go a little bit longer before central banks like the RBA actually raise interest rates. They keep telling us that not till 2024 at the earliest. I reckon it could come a little bit earlier than that, probably 2023. But in the interim, the bond market will start to anticipate that. So you probably will see a bit more of an upwards drift in bond yields.
So coming back to how our investors are behaving at the moment, what do you think are some of the biggest mistakes that people make when investing?
Well, the biggest mistake is one that we're all prone to, and that is to pay too much attention to recent developments. It's a bit like the weather. If you get a run of sunny days, you assume it's going to continue. If you get a run of rain, you know this is going to continue, sort of thing. Investors are prone to do that because it's always hard to have in your brain a model which will accurately work things out in an unbiased fashion. So people use little heuristics or rules, and one of them is to look at the current environment and project that off to the future. And so a lot of people, unfortunately, got out a year or so ago when the markets came down, didn't believe the rally, and then of course they've only recently had to buy back in again. And of course they find themselves buying back in at levels not that far from where they were probably above where they sold out a year or so ago. So that's an obvious mistake that investors make. I think I do worry a little bit that there's still too much enthusiasm, or too much of a bias towards growth stocks, tech stocks. I reckon there's a lot of opportunities in share markets beyond that. Tech did fantastically well through the coronavirus problems and has been doing very well for many years now as we latch onto all the gadgets that are on offer from the tech sector, which have been fantastic, and you can't deny that. But by the same token, the valuations are very rich for the tech sector. They were a key beneficiary of the pandemic, whereas other parts of the economy are now coming back to life, albeit in fits and starts. Travel industry is lagging a little bit, but other parts have come back very nicely. And so I would tend to think there's a lot more opportunities in industrials, resources still, they've had a reasonable rally, banks and so on, relative to tech stocks. And I guess the other aspect with technology is that even though a lot of people can relate to it, this is something that particularly younger people would say, I can relate to the stuff I see on my phone or gadget. Just bear in mind also there is a risk that regulators might start to focus on it more and regulate the environment that tech companies operate in. We've seen that a bit already in Australia with Facebook and Google and others, but it is an issue going forward. We're seeing it right now in China, for example, that governments might try and reduce the market power of tech companies. So there are issues around tech, even though it still remains very popular.
If you could allocate $1 million into a hypothetical portfolio today, what would that look like?
The short answer is this. I have still a huge exposure to property because it's gone up so much relative to the rest. So I've got enough on that. So if I was given $1 million or had $1 million spare, I would allocate it to share markets. I would take a 50-50 mix Australia global. Within Australian shares, I'd probably focus across the banks, industrials and resources, about a third each. Don't ask me to name the stocks. I probably wouldn't bother to pick them, but a mix of those sectors. Globally, the other 50%, I'd avoid the US, but I'd probably go 20% in European shares and 30% in emerging market shares. And again, I would focus on sectors that would benefit from the recovery. Financials in both emerging markets and Europe, industrials, resources shares. In the emerging markets, I'm a little bit cautious at present because of the COVID issues in some countries, but I'd be prepared to look through that. And Asian shares have already come back a bit this year, so I think I would probably put the bulk of that 30% I said in emerging markets into Asian markets, which I see as good value and I think will benefit immensely from the ongoing reopening globally.
What are some of the pieces of advice you would recommend to investors today?
Well, the first piece of advice I would say is make the most of compound interest. And this sort of goes back to an economist that was around he's still around actually, he's still writes stuff, but he was a prominent market economist when I started my career, and called Dr. Don Stammer. And Don Stammer would say, make the most of the magic of compound interest, but allow that there's always a cycle. So those are the two pieces of advice that I reckon are paramount. Don Stammer sort of instilled them into me many, many years ago, and I haven't forgotten. And the reasons those things are so important is that ultimately the share market will deliver for you because of the power of compounding, that you're getting a dividend yield, dividend paid on top of your shares. If you reinvest that, then it's on top of a bigger amount in the year after, and it grows to higher amounts over time. History tells us that no one got rich investing in bank deposits because the rates of return are so low, whereas the share market offers you a much higher return. It compounds on itself and gives you those strong returns over time. But the trouble is that many people get blown off by the cycle. They think, oh, gee whiz, it's pretty obvious. The share market's through the roof. I've got to get off now. And they get off trying to protect themselves against the next downturn. Turns out that we didn't get the downturn and they've got to get back in when it's a lot higher again. Or alternatively, they think they'll get out. They manage to get the downturn right, but then they never get back in again. So there's all sorts of problems around trying to time it. So the trick is to allow that there will be a cycle. It's part and parcel of investment markets. There is always a cycle, but don't get blown off by it. If you can have a process to try and time that cycle, but if you're not going to have a process, or you don't have confidence in timing it, then you're better off just making the most of compound interest. Now, around all of that, I think it's a focus on investing for the long term. I love what Warren Buffett said. His idea when he buys the stock is he's going to hold it forever, sort of thing. And I think the other point is to turn down the noise, which is that all the noise around investing, focus on a few key sources of information that are hopefully curated, put together in a decent fashion in some way so you can make sense of the universe that you're investing in.
Absolutely. Could you share with us, Shane, what's the best investment that you've ever made?
Unfortunately, it's inconsistent with my favourite asset class. It's property.
Yep.
But this was a bit of luck. I managed to get, because I'm a bit older, somewhat old, but I managed to get into the property market just at the time you really wanted to in Australia, and that was in the mid-90s. I first got into the early 90s, so it was in recession. That property went virtually nowhere. I think we paid about 300 for it and sold about 300 and bit for it, but not much. Amazing, talking about 300,000 for a property. But anyway, the next one came along in the mid-90s, and this is when interest rates, they came down after the early recession, then started to go back up again. So we're around 10% mortgage rates, middle of winter, no one wanted to buy it, Sydney's northern beaches, people were desperate to sell, they had bridging finance, and I happened to come along with my mother, I think it was, through the day and saw there was an open house in there. No one was at the open house. The house had passed in an auction. Now that property's gone up multiple times since that purchase. And that was the start, not me, but the timing happened to be at the start of the massive property boom we've had ever since. So I'd have to say that's probably my best investment. Obviously, we had to invest in the house. The reason I call it renovate the house because it was pretty old back then. The reason I call it investment is that the reality is when you're buying a house, you want shelter, but there's also a reality in it that you have part of your wealth tied up in that house, and that has to be seen as an investment. So it is both. Unlike shares, which are just an investment, they're wealth, but in the case of a property, yes, it's shelter plus an investment. So that's why I include it in the answer to the question.
I think people dream today of turning up to an open home and seeing no other people there. I don't think you get that in Sydney these days.
It's weird that it even happened. I happened to stumble across it going for a drive with my mother. My father had unfortunately just passed away. And so I was going for a drive one Saturday afternoon and then happened to see an open house that no one's at. And how lucky could you be? I mean, sometimes in life you get lucky like that. But I guess I probably capitalised on it because with my wife, because I'd recently gotten married, we convinced each other that we could afford the mortgage, which back then was a massive mortgage. These days it's a non-event. If I tell you the amount, you'd laugh. You'd say, oh, that's nothing, sort of thing. But I think I was really lucky, but at least I sort of had the foresight to realise that property would be worth a lot in subsequent years, and was prepared to sort of stretch a little bit to take on a bit more debt than I probably would have been comfortable with.
And you're still in the same house, is that right?
Well, we're still in the same house, and it has been renovated several times in the process. It was an old house built in either the late 40s, not that old, but late 40s or early 50s, and it had a butterfly roof. But out of the middle of the butterfly roof comes something like a Westerway extension on the top, which was really nice. makes it like a mansion sort of thing, but it was all inconsistent and angles were going all over the place. So it needed a lot of work to get it right, which we spread over 20, 30 years.
Tell us a little bit about your personal investing strategy. Who has influenced you the most? Is it something you've learned from your family or perhaps your education? What brought you to become, a leading economist in Australia?
Bit of luck. Well, that part, I mean, my family encouraged me to study, so even though my father and mother hadn't hadn't gone to university. I think my father left school as soon as he could when he was about 14 or 15 or something. My mother a couple of years later. They hadn't been to university, but they encouraged my sister and myself to go to university. So they saw the value of that, even though those around them at the time weren't doing that. Like, I don't think any of my cousins went to university. So that gave me an advantage. My high school economics teacher got me interested in economics. At the time, I thought all economists do is teach economics, though. So it's only when you go to university and you see other avenues in terms of what economists do. My university professor encouraged me to study finance. I only came across him in the fourth year at university when I did honours, and he was the supervisor of my thesis at the time, and then he also became the supervisor of my PhD thesis, which is on speculation in investment markets, which in today's jargon would be behavioural finance and asset bubbles or something like that. But this was 30 odd years ago. More than 30 years ago, in fact. So he inspired me in a whole bunch of ways. One, the importance of finance in the economy. Secondly, once you start something, finish it off, because I started my PhD and then constantly stopped it lots of times along the way. But I think that gave me the leg on into finance. I mentioned Dr. Don Stammer, who's had a huge influence on me, just in terms of the glib lines, compound interest, and there's always a cycle. It's stuck in my brain that you've got to allow for this and make the most of compounding. Over the years, I have to admit Warren Buffett's been a bit of an influence on me. I think you also have to be, I work for an organisation that focuses on active management, and a lot of us do that. But you've got to be realistic about this. So I must admit Jack Bogle's comment that why spend all your time looking for the needle in the haystack? Just invest in the haystack. Also has to be allowed for when investing. You want overall exposure to the market. Don't spend all your time just focusing on the perfect stock, because odds are you'll miss out on the returns that the overall market provides. They're probably the main ones, to be honest with you.
And so you started AMP nearly 40 years ago now. You came straight out of university, is that right?
I did, and my kids tell me life was very easy back then. I went to the university careers programs. There was a bunch of employers there. I applied for a bunch of roles. AMP happened to be there, and I hit it off with the AMP guy and then got a job at AMP. So it was all very simple, which was odd in a way, because I thought of AMP as a very, very boring just life insurance company back then. This was 1984. By the way, but I have been there ever since. You might say, well, how come I've been there for so long, since 1984, January 84? A whole bunch of reasons. One, they gave me a lot of opportunities in investments to focus on economics, which is what I love. So I reckon I've ended up with one of the best jobs in the country in terms of what I love, economics, in combining that with investing, and then combining that with communicating to people as to how to make the most of investment markets. But they also gave me time off to study, to complete my PhD. So I felt a degree of loyalty to AMP. The other thing that inspired me about AMP was the noble purpose, which is on the side of the building, not far from here. Amicus Certis, if you Google Amicus Certis, there'll be references to the Latin of it. There'll also be a reference to AMP's motto, which is a sure friend in uncertain times. So that inspired me. I like companies with a noble purpose. So even though the company can go off the rails, doesn't stop the company, the corporate, having trouble, like AMP has had for the last 3 years, which has been depressing and distressing. But I think if you can stick to that noble purpose, you can find your way back. And that's why I've been pretty happy to stay at AMP. It hasn't always been smooth sailing. I mean, the last few years have been tough. But I must admit, having that noble purpose, knowing that a lot of people at AMP do come to work to do the right thing, inspires me. And that's why I'm confident about AMP's future.
Now, outside of your sort of strategic and investing life, you have a wonderful family, and you also have a lot of passions outside of work, as we all do. One of them you've listed down is gardening, and I think a lot of people, myself included, jumped onto a gardening bandwagon during COVID when we had a lot more time on our hands. Is this something that's a recent pastime for you, or is this perhaps a lifelong, love?
No, I don't think it was natural. When I was at home with my parents, I had not much interest in the garden. I mean, I would play in the dirt and push cars around and that sort of stuff, like little kids do, but I wasn't really into the garden. There was phases there where you'd get into growing vegetables and then you'd lose interest. But once I got a house, and this is the benefit of having a house, I think, is that it can take your mind off your work. It gives you that break. And once you've got a quarter-acre block, that's the sort of the ideal to me, because you can rearrange the block and do things out the back and out the front and grow different things and go to Bunnings and Flower Power, and it's just amazing. I remember April last year, in the midst of the pandemic, people in Flower Power buying all this stuff, and then you put it in the garden and see it grow, and now I get the benefit of that. So it's sort of something that I've grown into in the last few years, and it partly came because I'd look at the garden and see there's just a lot of weeds in there. I want to rearrange it, then I put a garden bed in, work out how to build the walls, first out of stone, and then I was doing it out of logs and things and bolting them all together. And then you've got to buy the stuff to put in there and the plants. So and then the watering system. So it's quite a logistic challenge, and it takes your mind off what your work is and other issues that might be distracting you.
I mean, this is why we've seen Bunnings and similar retail groups have such a great recovery play, a great time during COVID. A lot of activity.
Well, they certainly have. I mean, this is the funny thing, and perhaps something I missed initially in this process. As we went into recession, the recession was massively different. It wasn't that everyone lost their jobs and become a lack of confidence. The government protected a lot of those jobs with JobKeeper. But the point is, we just couldn't do the things we normally did, like go on an overseas holiday. So you've got a certain amount of money put aside for your overseas holiday or Australian holiday or whatever, and then you think, I can't do that, but I can go down to Bunnings, I can go down to Flower Power, I can go down and put Officeworks and put a new home office in, or fix up the lounge or whatever. I can do those sorts of things. So the spending has been diverted from things you couldn't do, and of course that included services to some degree, to spending you could do. Now, of course, we have to allow as investors that money might go back the other way in the years ahead as the other parts of the economy come back. But it's certainly, I think it's been a bit of an eye-opener for many people that they've discovered these other things, and that's why you've seen this greater focus in the real estate market towards lifestyle. And people saying, if I'm going to be working at home, I want to have a nice, decent-sized house, probably with a backyard or something, or a nice location or whatever, so that people's motivation in terms of the property market has radically changed from just being, I want to be close to work.
Do you think that that's going to have a really sticky factor, or do you think that everyone's enjoying the regional areas and the regional boom at the moment, but eventually they'll gravitate back towards the CBDs?
Well, it may, but there's several reasons why it might last a little bit longer. Firstly, the coronavirus thing seems to be going on forever. It's like a soap opera, It's like I used to watch Days of Our Lives or something on the TV. Is that still on the TV? But anyway, I don't know. Days of Our Lives started in 1936, or I don't know, whatever it was, but it was still whenever TV started. And the reason I mentioned Days of Our Lives is because when I was at university, I would be studying through the day, then I watched the Mike Walsh show, which was like this midday show. This is a long time ago. And then after that, the Days of Our Lives would come on, which was the time to stop watching the TV. I'd go back to my work. But anyway, it's like the soap opera. We go from another breakout here to another, and then it's onto the virus and the vaccine and all that sort of stuff. So it's become a bit of a soap opera. And obviously, if something is short-lived, if it just lasted March to May last year, then we probably would have forgotten about it fairly quickly. But here we are, we're still having periodic snap lockdowns. The vaccine rollout is getting pushed further and further away. I'm not too worried about it, but because we've got it under control anyway. But nevertheless, the time when you get back to normal is getting pushed further out. And even in countries which are a bit ahead in terms of the vaccine, have issues as well. So it looks to me like it's longer, and when something goes on for longer, then people's mindset gets more permanently affected, which may mean that the working from home phenomenon persist for longer. I'll come to the office, I'm in the office today, but the norm seems to have become you're at home 2 or 3 days a week and you're in the office 2 or 3 days a week. So that sort of balance continues. I think that will probably continue. And I think the other thing for Australia that may last, the other thing that's happened with pandemic is that it's shown how to use technology. That's facilitated the work from home thing. And arguably that actually adds to productivity. But it also has the effect of enabling a greater focus on lifestyle. That's why I tend to think there's a good chance that it probably could persist for longer than a 1 year wonder.
So you also have on your Twitter listed being nice as one of your defining characteristics, and I find that so delightful and also so fascinating because Twitter is not a very nice place most of the time. Tell me why being nice is important to you.
Well, I've always thought it's important to be nice to people because I believe in karma to some degree. What goes around comes around. You give, but I think related to that is if you're nice to someone, you'll get something nice back. I mean, I cut to the nutshell of it. But the reason I put it on my Twitter account was that when I started tweeting, I was initially shocked at some of the comments I get back. People seem to turn their filters off on Twitter. And that leads to comments that they probably wouldn't make face to face, but they're quite happy to make on Twitter. And so after a while, I thought, I'll just to annoy people, I'm going to put here being nice on there. And I think that's important in a world where people's filters have been diminished by social media and it seems like people are becoming less nice. I think some people have to stand up and say, yeah, we want to be nice and respectful. It's like this backlash against political correctness. Now, I can sort of understand that political correctness can get taken to an extreme. But the flip side is that political correctness is really just about being nice to people and respectful about other people. And unfortunately, in the world we've come into, that respect has been diminished. And social media is contributing to a decline in respect. So I think it's important to stand up and say, yeah, I want to be nice, I want to be respectful, and generally be a nice person.
That's lovely. I think we need that to balance the scales quite a bit. Thank you so much, Shane. It's been great to chat to you today. Thank you for your time and thank you for joining us.
My pleasure. It's been fun to be here.